Position and Money Management Part 2. Well, in Part 1, we talked about your professional approach to investing and trading. It was based on how to measure risk. Is that going to be $1,000 or 1,000 shares? We talked about calculated losses, not gambling. This is a major key to your success. We also talked about aligning your trading time frame and risk management. How much are you going to risk per trade, per day, or per week? Where are you going to place your stop and why? We use charts to assess that, our entry, our target, and our stop. We cannot make it to a large target in trading from a small time frame. It just doesn't work. You have to decide, is day trading for you? It doesn't have to be. However, if you wanted to trade from a higher time frame, say a 30-minute chart or a 60-minute chart for intraday trades, entries, and exits, that's fine as well. Is your personality made for day trading? It may be, it may be not. There are traders that, just as I've talked about, were just nervous traders and they couldn't do anything else but day trade. Could never hold overnight, and that's fine, as long as they have a plan for doing it. And it's a profession. You have to treat it like one. And as we go through the course, you're going to see how exactly you're going to be able to do that, managing positions in the proper way and proper money management. We need help. Oh, we need rules. Once you're in a profitable position, to attain that larger gain, we're going to have to let it correct. There's no way around that, and there's no way to know the extent of the correction. And it does require giving back part of the gains to acquire that larger correction. Like I said, there's no way around that point, but if the stock hasn't reached a target area of resistance if you're long, or an area of support if you're short, the odds are with you. Of course, that's going to be based on the proper assessment of the trend and entry point. But you need to do it objectively. Let's figure out how. We need guidelines for raising stops. We'll start with the first point of reference, that being a prior bar's low if you're long, and that being a prior bar's high if you're short. That prior low is an area where there's support initially and resistance at the high. Now, if you're long a position and you're trading within a void, you're going to want to hold on to at least part of that position, even if it violates a prior bar's low. I'll talk about when to use a prior bar's low. Now, unless prices are accelerating, you're just going to sit and let things develop, meaning the price action to unfold. If they are accelerating far away from your entry point, it's okay to sell half below a prior bar's low. It's liable to correct at that point. So once that does happen, let it pull back, and we're going to wait for a pivot to form. I'll explain that. But once that pivot is established, you'll then bring your stop under that pivot low for longs. As the stock moves closer, supply, and I interchange the word supply for resistance because that's where sellers are going to be, the stop is brought under the prior bar's low again, and ideally that's happening as prices begin to accelerate to your target point. Let's talk about the two position management methods. There are pivots and there's bar by bar. A pivot process of managing that position, we need to let it pivot, of course, and establish a reference point of resistance with some price action occurring over a period of time. So we're going to define that as a minimum of two higher low bars to the left and right of the pivot bar. So here you see a move down, and then momentum begins to stall, and prices move back up again. So once we have two to the left and two to the right, we say, well, it's pivoted enough for us to consider raising a stop under that low. Now, once it takes out this high, well, and that has established an even stronger pivot point, the more bars you have to the left and to the right, the stronger the reference point, because the more trading action has gone on, more time has passed by, and that's established a stronger reference point for us. And we're going to continue to monitor these pivots as they form and how the price action unfolds. Now, bar by bar is just what it says. As each bar forms, it provides us a new reference point of support for longs. So when every single bar begins to form and then close. It has created a new reference point, and during periods of acceleration, we could begin to trail bar by bar. Not until that happens would we even consider it, because it would just be too tight and the odds of being stopped out are extremely high. So here's a pivot, and we're going to look at this through multiple time frames as well. So there are times when a 2-bar reversal, we could use that as a reference point to raise or stop. However, we only want to do that once we have a larger reversal. Smaller reversals tend to be meaningless for the most part. So once we have a larger reversal, a larger red bar down and a bit larger green bar up, we know that that is going to be a pivot in a smaller time frame. So we can trail under a 2-bar reversal if it's a larger reversal. Combining the management methods. So assuming our entry right here on this turn, the price is accelerating, and we define accelerating by multiple bars moving in the same direction where the opening price is right near the prior closing price. So we got a large move in one direction, multiple bars moving that way, and the separation between the bars is really defined by the time frame that we're using. In other words, if this was a 5-minute chart, our software would be saying stop collecting data, start collecting it on the new bar, so on and so forth. And this would be a large bar in one time frame. Now the point here is that when they begin to accelerate in this way, it's creating what we call a price void. In other words, there's no support underneath it, which the prices could then pull back a relatively significant amount. If this is the beginning of the move, it really shouldn't pull back that far, and typically will pull back into the area of what was resistance and becoming support, and what we call an area of minor support. That being said, in reality, there's really little to nothing underneath here, and the assumption is that this technical concept is going to hold, and that's where the turn would be. So we take partial profits, but then we will let it pivot. So once it pivots and begins to turn up, we can then begin to trail that pivot. So we only do bar by bar if prices accelerate. Otherwise, once it's halfway to target, you can use a pivot once it forms. Now, as it's pushing higher and pushes up above the prior high, what you could do is move to a lower time frame to use pivots as prices begin to accelerate. And I explained in the way to do that, looking at this time frame, looking for a larger bar. We'll look at this in another slide, but as prices transition from a red bar to a green bar, there'll be pivots there. You'll learn to look at this and understand it within multiple time frames. If you're taking the whole course, review the multiple time frame sections again, where I cover that extensively. As it's moving higher, as it gets closer to your target, and ideally, as I explained, begins to accelerate, you then begin to trail bar by bar again. And so once it begins moving higher, you then begin to trail your stop under the prior bar's low. So here's an example of the two time frames and a larger bar reversal right here. And we're talking about the transition from red to green. And this 2-bar reversal, ideally in a higher time frame, is going to be a pivot in a lower time frame. This is how momentum slows down, and it always does. Just depending on the time frame you're looking at, you may not see it. Because to turn from this red bar into a green bar, in some time frame, momentum slowed down, and these are examples of how that can happen. It can happen in a multitude of different ways. I'm just showing you two. And how it turns doesn't matter all of that much. And it's to understand, as you look at those lower time frames, it has to pivot, it has to turn, the momentum has to slow down, and the smaller the time frame you look at, the more bars you're going to see by definition. Well, there's just two examples of how that might happen. This is for that reason we'll trail under a larger 2-bar reversal. We don't want to use any 2-bar reversal or small reversals because they can be relatively meaningless, just some noise choppy price action. So those larger reversals tell us that there was an increase in volatility, and once that turn happens, it shouldn't go back underneath it. Because of that turn, it should continue in the direction of the turn. And it says ideally this happens during times of increased momentum. And we talk about bases and trailing bar by bar. You don't want to do that right after you get in. It virtually ensures being stopped out. That I can almost guarantee you. So there must be a period of acceleration to create that void. At those times, you'll consider selling half. Now, trailing after a base, as we all know, the ideal situation on a breakout is that prices don't move back under the bottom of the base or even back into it. However, we need to consider the size of the breakout bar. If it's a small breakout bar, it's of course not the ideal, but it might come back in and wiggle around. If it goes back down under the way I've shown you here with this shakeout, clearly something is wrong. This is how you want to look at bases. Buying breakouts from a base is one that has this type of a shakeout. And I've shown you with a bottoming tail bar. However, it could be a red bar down and a green bar right back up again. The message would be the same. And during a shakeout, you have that move to the downside. Prices come back up to where they were consolidating, and they consolidate again, and then they break out above the range. Now here we've got a wide range bar breaking out of that range, and prices should not go back down below the low of that wide range bar. Many times you're going to get a stall in momentum. It could be an inside bar where prices consolidate. One of the concepts covered in the multiple time frame section is that a wide range bar creates a void, and there's a lot of smaller bars in a smaller time frame. So a consolidation after a wide range bar is relatively normal. The ideal scenario, of course, is when we buy a breakout and wide range bar and then you get another one and prices accelerate higher. Doesn't have to happen that way, but when it does, it's great. Well, the bottom of that bottoming tail bar is going to be a pivot, just like a 2-bar reversal. As I said, whether it's a red bar down and a green bar up or it's a bottoming tail bar, there had to be some slowing in momentum and a turn in a smaller time frame. Now, this isn't to suggest that you'll be buying this. Not in a situation like this. Type of a shakeout is one in which we observe it, we put it in the context of a trend, and then take action at the appropriate time. So our management of a position is based on the understanding of corrections and price action. I mentioned minor support as prices move up and clear resistance as they pull back to it. That reference point of minor support is often where prices are going to turn up, even though there's nothing of real significance here to the left. This even subjective reference point that's widely known by almost anyone that looks at a chart is where they're looking to buy, and it becomes a self-fulfilling prophecy and exactly what we want to see after a momentum move up above it. Now, the strongest of trends, many times they won't even pull back this far. They'll go sideways, and that's much more bullish. Once prices begin to turn here, ideally they'll take out that high, and once they do that, we now have a reference point, a new reference point, which would be major support. Up above here, this is our major support, this is our minor support, and then we'll look to see how the trend continues. Already talked about the base and the shakeout here, the pivot, and this would be a higher time frame. This could be a lower time frame where we would see that type of a pivot. And I said it's the bottom of a tail or a 2-bar reversal is going to show us that slowing momentum. Prices push up above the old high. We then have a new reference point of major support that we would not want to see violated. And this is how we then monitor the trend on a continuous basis, bar by bar, and then as pivots form, we then trail stop. Let's move on to part number 3.